What's the first thing that comes to your mind each time you hear the word life insurance? Death? What if I tell you that life insurance is not about death, but has so much more to do with life and benefits that you get while alive? In today's video, we're going to be looking at 7 genius strategies to build wealth with life insurance that you feel like you can actually eat your cake and still have it with these strategies. These are time-proven strategies, mainly hidden in plain sight, that majority of the people do not know about. It doesn't matter whether you're new to personal finance mastery or you're an experienced investor. Today's video will break down these time-tested and proven strategies that the wealthy use to build wealth into actionable tips to maximize your wealth building experience and optimize your life insurance policy for long-term financial success. But first, you need to hit the like button so you can stay updated each time we drop new videos. And if you've already done so, then like, subscribe, comment, and share this video so the algorithm will be able to get it across to everyone that needs to see this video. You see, life insurance has been there since time immemorial. It's been there since the Roman Empire. During the time of the Roman Empire, it wasn't actually called life insurance. It was then known as the burial clubs in the Roman Empire. At the time, the members of the club, they contribute money each time a member of the club passes. This money they use as final expenses to do the funeral rites and the interment. That has been ongoing in this elite society, those that belong to this burial club. From that era of the Roman Empire across the line to the medieval age, somewhere around 8, someone in England, a man named William Gibbons, became known as the first man to sign a contract that if or when he dies, there's going to be a benefit that will be transferred to his heirs. And that was the first recorded contract about the concept of insurance known in history. You see, this has been an ongoing thing, but it's been concealed in certain class of the people. But then the modern life insurance took effect somewhere around the 18th century, precisely 1706, when an organization known as the Amicable Society for Perpetual Assurance came up, and they began to take money from certain people in their membership to provide protection for them, known as an assurance at the time. This then led to the evolution of life insurance. The news started spreading from England across Europe to America to Australia. Before you know it, it went all over the world. At the time, the missionaries that went with the colonialists, they made sure that they had their life insured. So whatever happens to them in the foreign land, their family and loved ones gets some sum paid out. That's how life insurance has evolved over time. All this while life insurance has been evolving, it's been an exclusive right for the privileged few, the wealthy class. So they created this financial instrument, and they've been the beneficiary of this financial instrument over time. Now the information has come to you. Are you ready to do what this same class that created this financial vehicle known as life insurance has actually been using life insurance to do? So you can do what they are doing and get the kind of result they're getting? The question is left for you to be answered. Mine is to share with you the benefits that you can get from life insurance while you're alive. It's like buying a car. You want to buy a new vehicle, and your main reason is you want to move from point A to B. You go to a dealership and then you buy a car. Aside moving from point A to point B, there are other uses that you can actually use with your car, right? Yeah, with that car that you've bought or the vehicle, you can actually move passengers too from point A to point B. And you can also move goods from point A to point B. Do you know that car that you bought can also be used for tax write-off? But that's also a benefit, right? And it can also be a status figure. There are lots of other benefits that you can actually get from having a vehicle. Same also is with life insurance. So sit back, let's look at the 7 genius ways to build wealth with life insurance, just like the wealthy do. First, like, subscribe, and share this so others can see. Number 1, living benefits. You don't have to die before someone else can benefit from your life insurance decision. Let me share a story about Susie. Susie, in her 20s, needed a lot of money to finance her education so she can go to a university, so she can qualify for a good job. One fateful day, while doing their financial education campaign, they met Susie and have a conversation about financial planning and the need to have an insurance. For some reason, she decided to give it a try. She bought a life insurance protection along with some riders that she felt was important at the time. Fast forward 6 months after, just like everyone else, Susie was sick during the flu season, and it just kept going. The flu kept increasing. She was worried, so she went to the hospital and they did some tests for her. A few days after, she got a call to come to the hospital. She went to the hospital, she sat with the doctor, and then they went through with her and sorry, the results that we have shows that you have cancer. She was shocked. Young girl in her 20s. Cancer is supposed to be something for people that are old, tired, or retired. How come? She's just only 20 years old. That was the result. The doctor explained the reason they didn't call her earlier was because they had to do a test to make sure that the result you're getting is accurate. But now that they're sure, that's why they gave her a call to come to the hospital so they can let her know. So she was shocked. But it didn't end there. Now, her life took a twist because now she has a terminal illness. She now has emotional stress to contend with. And like we all know, cancer is very predominant in the Western world, especially in the North America. There's a study in 2023 by the Canadian Cancer Association. On their website, cancer.ca/statistics, it shows that 2 out of 5 Canadians will have cancer in their lifetime. 2 out of 5. That's about 40% Canadians will have cancer in their lifetime. The study further reveals that 1 out of 4 Canadians, whopping 25% of Canadians, will die of cancer. So you see, cancer is very predominant. It's like having malaria fever in sub-Saharan Africa. That's how predominant it is. The fact that she has cancer has certain setbacks on her career. So she lost her job as a result. In order for her to survive, she was lucky she had life insurance that she bought 6 months back with the rider of critical illness protection. With the help of our financial advisor, she was able to call the insurers, let them know the situation, and show them the medical reports. And guess what? She received a whopping sum of $250,000 cash, which was part of the coverage in the critical illness rider in a life insurance plan. Wow, imagine $250,000 when you lose your job. At least she was able to pay for her mortgage or pay for her house rent, pay for her car notes, pay her monthly bills, take care of her health, and have time to focus on a therapeutic healing process. Now she's not worried about where money is going to come from for bills and all. So she's able to take care of all this with the help of that money. And guess what? Usually when someone gets cancer or serious terminal diseases, it's going to take between 3 to 5 years to get back to the job market. She was able to focus and fight the cancer, and eventually Susie came out victorious. But then, while Susie was going for a medical at the hospital and meeting the therapist, she noticed that so many people in her community, especially the black communities, were vulnerable. They had different terminal diseases they were diagnosed of, but most of them are not as lucky as she. They do not have any life insurance protection to get money so they can take care of themselves. Some of them are still struggling with an ailment to go do factory jobs just to pay their bills. This became a purpose for her to make sure that she educates the community and help people around her to be able to protect themselves and protect their income and protect their family by so doing. That's how she became so passionate in the campaign for financial education. If that story actually resonates with you, the question is, what are you going to do if for some reasons you're not able to go to work anymore, maybe due to medical or health conditions? How do you plan to fund your lifestyle? How's your family going to survive without the income that you currently put on the table? I'd like to hear from you. Go to this comment section and let us hear your thoughts and share your own ideas with us. Number 2, supplementary retirement income. The average life expectancy in North America is about 82 years of age. For the male, it's about 81, and for the females, it's about 83. But then, retirement from active work starts at age 65, right? What if you retire at age 65 and you happen to live long till age 100? How do you plan to fund your golden age? Okay, I asked this question once and someone says, I'm going to be getting money from the government. Someone else said, I'm going to be getting money from my employer's pension plan. But you see, the government's arrangement and the employer's arrangement are both good. But due to rising inflation and the increasing needs at retirement, do you think that money you're going to be getting is going to be sufficient for you to finance your golden age? Let's look at this. During the golden age, there are several needs that you have to take care of. You want to have regular health care. You want to take care of yourself after retirement. Yeah, and also you're going to have some dietary needs. You're not going to be eating junk foods like you used to eat right now. You want to eat healthy foods that will put nutrition into your body that gives you strength and vitality, because your body has reduced capacity to process certain things at that time in life. Also, you have needs for some caregiver. You need attention. You can't do things by yourself now. You need someone else that will help you to do your laundry, clear the grasses, or plow the snow. These are needs that you have in that time. And you also want to make sure you go on vacation, because you spent most part of your life working hard. Now you're retired. You want to see the world. You want to go to the north, east, west, south, everywhere. And you want to do this with your children, grandchildren, and maybe your great-grandchildren. Also, you want to make sure you leave a legacy behind. You want to transfer wealth to your next generation. He said that a good father leaves an inheritance to their children's children. So you also want to be a good father, right? You want to leave inheritance to your children's children. And also, you want to plan your final expenses. You don't want to die and leave your children with the burden of coming up with the costs of final expenses, which could be anything between $10,000 to $40,000. Just to get you back to Mother Nature. But how do you make sure all these are in place? In order for you to enjoy your retirement hassle-free, you want to make sure you have steady cash flow to take care of all these needs. Because you don't want to be 95 years old and be doing cash work in a factory or working at Walmart, right? A cash value life insurance plan, well structured, has the capacity to guarantee you a steady income flow in your golden age. And depends on how well it's structured, it can give you cash flow on a monthly basis, on a quarterly basis, or an annual basis for the rest of your life. And when you're no longer there, the death benefits becomes the wealth transfer strategy that you pass as an inheritance to your children or children's children. Isn't that genius? Think about it. Have you heard about this statement? You can't eat your cake and still have it. That brings us to number 3, collateral for loan. My friend Douglas, also a financial advisor, has been in this business for quite some time. Before becoming a financial advisor, Douglas has worked in the bank, so he has an idea of how the banking system operates. Upon becoming a financial advisor over the years, he has been able to set up 19 different cash value policies to protect himself and his family. While having a conversation, he shared his thoughts and he said he has his life insurance policies not for the death benefits only. Being a businessman, each time he sees an opportunity to do business, he needs access to funds. And in most cases, going to the bank to get a mortgage, he has to go through the pre-qualification process, which in some cases comes out with outrageous requirements. He knew that if he has to stay in business, he needs to have access to funding for his business. So what he does is he has 19 different cash value insurance policies where he's able to grow his money tax sheltered. Each time he finds a good deal, he simply goes to his insurance policies, 19 of them, check the cash value in each of the policy, and assess loans from each of these policies. And the reason he does take it as a loan is because he wants to eat his cake and still have it. And I'll explain. It takes the cash from them, puts them together, and he has a lot of cash to buy property outrightly, puts the property in order, and puts it back in the market. And when he closes the deal, he makes a profit. And in most cases, it takes the capital and the profit and put it back in the insurance policy. How does this work? Here's how it works. A cash value insurance policy has the capacity to grow wealth tax sheltered, meaning whatever amount of money is growing inside the account doesn't get taxed. The only time it gets taxed is when you are withdrawing from the account. But if you're borrowing against the account, you don't get taxed because you don't get taxed on loan. This money is able to grow inside the account tax-free, and you're able to still borrow that same value of money to do business, and you still have the money growing there at the same time. So you still have your cake while you're eating it, doing business. Isn't that a genius way to grow money? Think about that. Number 4, college education funding. In a knowledge-based society as obtainable in the Western world, the quality of education that you give to your children will determine to a long extent the quality of life they will live in the future. As you all know, quality education is not cheap. So as parents, we all want to give the best to our children. Education is the best legacy that can be bequeathed to the children. We've heard that cliche. But how do we guarantee that our children get a quality education, whether or not we are there? One of the best ways to do that is to set up a cash value life insurance policy as early as possible for the kids. The earlier you're able to do this, the more the cash is able to grow in the policy. When the kids get to the age of education, all they need to do is they borrow against the policy to fund whatever kind of education that you have planned for the children. By so doing, you have been able to use one stone, one policy, a cash value policy, to kill two birds. First bird, secure a policy for them as early as possible, a lifetime coverage. And second bird, from that policy, you're able to pay off their education and still have the policy growing with an insurance coverage. Isn't that genius? What about you? What plans do you currently have in place to ensure that no matter what happens, your children are able to get the best quality education, whether or not you're there? We'd like to hear from you. Let us know what strategies you currently have in place to ensure that your kids are able to further their education, whether or not you're there. And let us know if you do not currently have one. What plans do you have to guarantee that your kids have the quality education, well, no matter where you are in the world? Let us know also on the comment section what results you're getting from that plan and what are the challenges. We'd like to hear you out. And that brings us to number 5, lock in insurability. My friend Chan, 33 years old, is from the Oriental Extract. We were having a coffee sometime and I asked him a question. I said, Chan, how come you are able to own several investment properties, about 5, in your name at this young age? How are you able to do that? What's the strategy? And Chan looked at me and he said, life insurance. Like, life insurance? So how do you use life insurance? Chan told me, he said it's a common Chinese strategy that when they have a newborn baby in the family, they quickly set up a life insurance in place for that child. And they continue to pay the premiums to keep that life insurance going. When the child comes of age of minority and becomes 18 or 20, as soon as the child gets into the workplace, they hand over the life insurance to the child. So the child carries on with paying that policy for life. As someone who has benefited from the parents having a life insurance from his tender age, they've been able to grow a significant amount of cash value in that life insurance for years. In his 20s, he was able to access this money as the initial capital, which he used to invest in real estate. And that's how he was able to start from acquiring first investment property and also be able to replicate that strategy to getting the second, third, and up to the 5th investment property. And I was like, wow, isn't that genius? Do you know that you can actually get your child the best deal and lock in the best insurability as early as 10 days old? The earlier you start putting funds into a cash value life insurance for your children, the more chances of becoming wealthy you are creating for your children in the future. So what are you waiting for? Number 6, early mortgage payoff. Have you ever heard of this phrase, buy, borrow, and die? Well, probably not, but it's an old strategy that's been used by the wealthy class to increase their wealth. So I met Emeka one time in Toronto when he came to open his clothing line. Being someone that's from the same background from Nigeria, we were able to connect. While talking to Emeka, I asked him, how are you able to access cash to finance all these businesses that you've mentioned that you're running? And he laughed and he told me, he said, what they do as a family is they're able to pool resources together. First, they get a life insurance coverage over every member of his family. Then set up a trust and transfer ownership of this life insurance to the trust. As soon as the cash value accrues in these policies, they're able to borrow from these policies to buy a business. Once they are able to buy one business, they buy an insurance that's 10 times the value of that business. Everything is owned by the trust. Eventually, they assess more cash value from their policies to buy more business. So that's how they've been growing and growing funds as a family over time to keep acquiring new business. I'm like, wow, fantastic. And then if any member dies from the family, the death benefits they get pays off the loan they borrowed to finance that business. So they can own that business fully as a family, thereby increasing the family net worth and creating more pool of funds which they can access to do more business. So the question is, what about you? What wealth building strategy do you currently have in place in order for you to build wealth? I would like to know on the comment section. We'd like to hear from you. And that brings us to point number 7. Immediate finance arrangements. If there's one thing significant about the wealthy class, is their desire to continuously eat their cake and still have it. The question is, do you have a strategy for you to eat your own cake and still have it? So George shared how he was able to finance his business using an IFA, and I'll share it with you. Each time George wants to buy a new business, instead of him taking his capital and pay for the business, first he set up a life insurance plan equivalent to the value of that business. Let's say George wants to buy a business that worth $1 million. He set up a new insurance plan for $1 million equivalent to the value of that business. And once he does that with an insurance under a special arrangement known as an IFA, he's able to pay that annual premium into that life insurance account. And under this arrangement, he can access 100% the money he paid into the account and take it out immediately and use it to do business. In that way, he has been able to create a net worth of $1 million over himself and his business, gain an asset protection for that business that he wants to buy, which is the life insurance plan equivalent, and he has also been able to leverage on creating a credit line through the insurance financing for that business, and also be able to protect his income and his assets. So you see, using this strategy, he has been able to use one stone to hit several birds and reduce his potential to lose. Isn't that genius? So let's hear you out. What strategies do you currently use to run your own personal finances? Go to the comment section, put it there. Let's learn from your experience. Also, if you think this video has been helpful or impactful in any way, form, or means, then like the video. Hit the subscribe buttons if you've not already done so the notification buttons will come up and you'll be the first to receive our next videos once released. Then share this video so the algorithm will be able to distribute it to a wider audience of people. And don't forget, an educated community is an empowered community. Remember, life insurance isn't just about protection. It can be a key wealth building tool when used strategically. So stay on track to master your personal finances. See you in our next video. Ciao.